hey, I want to talk to CEOs, not just of your current portfolio companies. I want to talk to 3 CEOs you fired. I want to see what they have to say. I want to understand if, sure, we all understand something went bad, but how were they treated? How did you treat them? And let's find out, did they treat them fair? But how did they treat you? Did they treat me fair? It's like how we treat people matters in life. And so we can learn a lot from CEOs who were fired. You do all of that, I promise you, you're going to do a much better job picking the right partner.
Adam, you're very welcome to the ScaleX Insider podcast. Delighted and thrilled to have you on the show today.
It's good to be here. Hello to all your listeners out there. Thanks for having me.
You're so welcome. I'm really looking forward to our conversation. We've had great fun off air, so I'm really excited about this conversation.
If we can get any of that magic in the podcast, this is going to be a classic. I can tell already.
Let's do it. You know, our vision is to inspire, connect, and enable millions of ambitious leaders of small and medium-sized enterprises to scale with purpose. So I open up the podcast with this question to all of my guests. Adam, what does scaling with purpose mean to you?
Well, first of all, let me just give you some statistics, not to bore your listeners, but these are U.S. statistics because I have them readily available. There's 33 million small businesses just in this country. There's only 3,000 companies on the planet that have $1 billion in revenue. The 33 million small businesses in this country, only 40% are profitable, 30% break even, 30% lose money. 33 million small businesses, only 7% get to $1 million in revenue. Only 4% of those get to 10 million in revenue. To grow a big business is really rare, and evidently it's really, really hard. And so, when I think about scaling a business, and I think about my career and how it's morphed over time, my focus now is helping entrepreneurs solve that mysterious equation and to find success, which seems to be, quite rare in today's world. So from my perspective, it's all about, ideally learning the basics of business, learning how to scale through the different various sizes so that all of us can be successful. So I left this lucrative CEO career after 21 years, building 3 national empires for 9 private equity firms, billions in exits. And I gave all that up because I wanted to help multiple companies at a time, just like you. I wanted to help multiple people find success.
What an answer. And I'm a stats geek as well. There are 5.7 million SMEs here in the UK. And actually the latest stats suggest it's only 0.5% of those SMEs, 28,000, are achieving scale. And when you think that more than 99% of businesses by volume are SMEs, and this part of the world, more than 70% of people work in SMEs, the work that you're doing, that we're doing at this end of the world, Adam, is aimed at getting leaders to consciously think about scaling with purpose, because that actually touches every corner of our society, and everybody can prosper if you have leaders who are consciously thinking about scaling with purpose. So I love that answer. You touched on your career. You have an incredibly interesting career. I'd love you just to share with our listeners, give them the abridged version of your career and how you arrived at the point where you became very knowledgeable about the world of private equity.
Well, like many people, it's a long, circuitous path, that we take through life, and we never, I don't think, ever think in advance. When I was a kid, I wanted to be a professional athlete, and and running a laundry company, $1 billion laundry company, was not high on my priority list. So, I tell people things about me. So I'm a veteran of the U.S. Army military. Military taught a young version of me about discipline, teamwork, leadership. Taught me about servant leadership. And I think it was a great foundation for my career. Number 2, engineering. Engineering made me a meticulous planner. And as a business person, always a strategic plan in place. Bad things happen in the world, strange things happen in the world, but we have to have a plan. If we don't have a plan, there's no way we know if we're on track to achieving success. Being a pilot taught me something interesting. And that was, when we're running a business or building a business, we have to start with an end in mind. What are we trying to accomplish? And so a pilot takes off. They never take off without knowing where they're going. what the weather en route is, what the alternate paths are. If we get into trouble in the air, we need to find an alternate landing spot. And so I think about business the way that I think about flying, the way a pilot is taught to fly, which is start with a destination in mind and, you know, an exit in mind. Doesn't have to be the end of the journey, but it's the first initial exit in mind, and then, you know, reverse engineer the path, have that meticulous plan, be the servant leader, care about people. And so then the third thing is I spent 10 years at General Electric during the Jack Welch era. I call it the Camelot era. GE is the world's largest company. There's no tech yet. Or at least Steve Jobs is still in his garage, you know, and the company, the world's largest company, is growing so fast, it's doubling in size every 2.8 years. And if the world's largest company can do that, then your company can do that too. And that taught me about the importance of growing at a 30+% compound annual growth rate. And so that, you know, I credit GE with teaching me how to run a business. Fourth, then I spent 21 years as a CEO building 3 national empires in 3 different industries, one of them international, for 9 different private equity sponsors. So multiple hold periods, selling the company multiple times, and billions of dollars in exits. I'm a buy and build guy. So I bought 58 companies along the way, combined them to build these empires. My last empire, I bought 23 and put them together. The one before that, I bought 34. And so buy and build guy, you know, buy a bunch of small companies, put them together, find that scale, you know, create the operating leverage, climb the PE pyramid. Small companies trade for a small multiple because there's so many of them. And then as you build a bigger business, remember, in our 2 countries now, 33 million here, I think I heard you say 5 point something million there, small businesses, only 3,000 on the planet that have $1 billion in revenue. And so big is rare, big is special, big is worth more than small. So I buy a bunch of small companies, put them together. I paid, like, on average, my last time, 5x multiple of invested capital, or I'm sorry, a 5x multiple of EBITDA is what I paid for these businesses, 5 times earnings roughly. And then when I sell the business that I built, you know, it's 14 times. And so I'm creating this arbitrage, which is the difference between the large, rare companies selling at a high multiple and all the little companies that I've collected and combined that I paid small multiples for. And so that's been my kind of professional journey. I got bored. I had been teaching in university as well, trying to give back, teaching the next generation of entrepreneurs and executive MBAs, you know, about entrepreneurial business and private equity and alternative asset investing and things like that, leadership. And so I started writing books, and I was like, I love teaching. I love giving back. I don't make any money. I love, you know, or I hate being a CEO. I made a ton of money. How do I re-engineer my life? And so a couple of years ago, I just told the world I'm done being a CEO. I started a consulting business. I now work with private equity firms, no surprise. I help them evaluate investments, and I coach and mentor their CEOs. And then I work with founders, you know, some in a peer group, some of them as individuals. They're all scaling their businesses. They're doing M&A. They're preparing for what's probably likely a private equity type exit. I help private equity identify risk. I help entrepreneurs remove risk. I'm also a matchmaker. I think I've helped over 300 million in exits in the last 12 months, probably another 300 or more in the next 12 months. I've got 3 entrepreneurs I'm working with who are in the market right now, hiring investment banks. And then I still write the books. I teach seminars globally, you know, to a global audience, and I'm having fun. That, I think, was the most important thing for me a couple of years ago, was transition from tactical execution of one company to strategy on multiple companies, and the entrepreneurs are now responsible for the tactical execution, and it's reinvigorated me, and so I'm having fun, which is most important.
Well, that is clear. And I want to touch on at the end, what some of your daily practices and routines and rituals are in terms of supporting you being continually reinvigorated, because the energy you've just delivered in the last 5 minutes is like, wow, it's just straight down the microphone. So I really appreciate that. I want to kind of pick through a number of the things that you've said, because there's a lot of terminology in there, and I want to kind of create a very simple masterclass for those listeners who are coming to the world of private equity for the first time. And I know we've covered this off in the podcast before. Our mutual friend Nick Bradley did a wonderful masterclass on getting inside the whole world of private equity. He worked inside private equity. You're coming to this from a different perspective in terms of leveraging private equity to support the scale up of your businesses. Some of the terms you've mentioned, buy and build, climbing the private equity pyramid, the multiples, arbitrage, the use of investment banks, all of those terms. I want to avoid any abstraction here and bring it right back, I suppose, to your wonderful first book. I have a copy here for those that are listening, the Private Equity Playbook. I encourage you to go out and grab a copy of this if you're considering private equity and you want to inform yourself about how that world works and how you should leverage it. Let's kick off, Adam. Why should SME leaders consider private equity, and maybe explain what it is again, just for the benefit of our listeners?
Sure. And Nick's a friend. And so you're right. He's a PE insider. He sees me as a tool to help build and run companies. I see him as a tool. I need capital to build these companies. And so we are each other's tools, and we're coming at it from opposite sides of the table at times. But Nick's a good friend, great guy. And so I'll tell you, I wrote that book because even to this day, if I give a seminar on private equity and I have 300 or 400 sophisticated entrepreneurs have more than $1 million in revenue, some of them hundreds of millions of dollars in revenue, if I give them a basic 10-question multiple choice quiz on private equity, I guarantee you 90% of the room will fail it miserably. I've only had one person out of thousands, over the last 5 or 6 years that have scored perfect, one. And most of them that pass get 6 out of 10. Most people flunk it miserably. So even to this day, everybody has heard the term private equity, but very few people have a working understanding of what it is, how it works, how it makes money, and why we should care, more importantly, as entrepreneurs. As we're building an empire, we don't want to build an empire alone forever. It's one thing to get out of the gates and build a successful small business, but at some point, we should absolutely monetize this asset that we've built, known as our company, and bring in institutional capital to help us grow. So today, on the planet, if I go back 21 years to when I was a CEO for the first time, 23 years ago now, there was like 800 billion in assets under management. There was, there was a little over 1,000 firms. Today, over 6,000 firms, over 5 trillion. Recent statistics I saw said 6 trillion in assets under management. Today, private equity makes up over 50% of the market. And so if I'm selling a company, there's a better than 50% chance I'm going to sell it to either a private equity firm direct and become a platform investment from which they will grow a bigger business, or I'm going to sell to a strategic who's buying other companies like mine, and they're backed by private equity. You can't go through a day in your life in any country without seeing a logo that is owned by a private equity firm. I was joking with someone. I told him, you can't even go to Denali National Park in Alaska and go camping by yourself without encountering private equity, because half your camping gear is going to be owned by a private equity backed sponsor or strategic. And so they literally have permeated every industry on the planet. And I worry a lot about entrepreneurs and their success. It's hard to build a business and be successful. Our statistics show that. But beyond that, entrepreneurs, as they find success, I find they take on too much personal risk. And I like to see them get asset diversification as they're building a business by actually selling a business. And so if you sell your business, most entrepreneurs think about it as a one and done event. I'm going to sell my company and I'm going to get a wheelbarrow full of gold. I'm going to hide it in a garden in the back. And then now I'm going to do something new. And I tell people, why do something new? Why learn something new? Why not continue building the company that you've already built, but now do it as a minority shareholder using institutional capital? And I just want to remind all your listeners, recently, I'd say it's changed because Amazon's stock price has come down a bit, but the wealthiest man on the planet, was Jeff Bezos, Amazon. And guess what? Jeff only owns 12% of Amazon. He's a minority shareholder. And he's the richest guy on the planet. That should tell you it's okay to not have control, that there are paths to wealth creation that involve you as being a minority shareholder. And so I always tell people, you should never get larger than $100 million in enterprise value without bringing in private equity. So you might have 10 million in earnings, 10 million in EBITDA. Over here, in North America, I'm probably selling that company for 10, 12 times, 100 million, 120 million. We want to get asset diversification, and private equity is how we achieve that. And it's because of private equity, there is a market to sell our companies. Without private equity's wealth, the multiples being paid, the wealth being created by entrepreneurs would not exist without private equity kind of creating this market in this attractive place where we can bring our companies and sell them. And so for your listeners, what's private equity? Think of a mutual fund. I can go on my stock trading account, Schwab or E-Trade or somebody, and I can buy a share of a mutual fund. It's publicly traded. I can hold it for a day, 100 years, however long I want. I have instant liquidity. Private equity is similar to a mutual fund. Mutual fund aggregates money from a bunch of people, a bunch of investors. We give them a bunch of capital. They go out, and the manager of the fund goes out and buys a bunch of different stocks, and that's what we're investing in. They make all the decisions. We're simply an investor. Private equity, same thing. It aggregates money from a bunch of different people or institutions. Generally, the smallest investment allowed is around 5 million. So these are accredited investors, institutional investors. They're giving large amounts of capital for as long as 10 years with no liquidity to a fund manager or a private equity firm that has funds, and a fund manager decides what companies to buy. First 5 years, they're investing the capital and picking the platforms from which to grow. Kind of the middle 5 years of the hold period, is the typical hold period. They're improving companies, making them bigger. And then towards the tail end of the fund's life, they're selling them all and giving the money back to investors. So you don't have liquidity. You need about a 10-year horizon when you commit capital to a private equity fund in order to get the returns. And that wipes out a lot of small investors, and it's a large, minimum investment size. But essentially, it's a private mutual fund that buys companies or invests in companies. There's different types of PE funds, and they spend this time picking companies to buy, improve, and then sell, return money to capital. And so in essence, that's what private equity is. I really would encourage you to get educated when you've got 5 trillion, 6 trillion in assets under management, and it's making up more than 50% of the market. I don't care whether you plan to sell to private equity or not. If it's also the world's largest non-bank lender of debt. So if I'm building a business, I need capital and the banks won't give it to me, or I'm buying a company and I need some debt that I can't get commercially from a bank. It's the world's largest source of non-bank capital. So we really need to understand how this works, because it impacts our businesses every day. Whether we choose to sell to one or not, we need to understand how money works in order to build a successful enterprise that can take advantage of this force called private equity. So think of it as a mutual fund, but private. Larger scale investors, 10-year hold periods, no liquidity, buy companies in the early years, fix them up in the middle, sell them at the end, return money to investors. That's private equity in a nutshell.
Brilliant. What an answer. Couple of things that I've heard in that, and I'm keen to make this very relevant to our listeners. There was one of the reasons you've cited as an almost an appeal to our listeners. You're saying that if you have a company that in this part of the world, $100 million, about 70 million pounds, 80 million pounds in enterprise value, then you absolutely should consider diversifying your asset, your primary asset, and liquidate a part of that by virtue of leveraging private equity, so monetizing the asset that you've created. What are the other, because a lot of our listeners won't have reached that scale in terms of the enterprise value. So what are the other reasons why we should consider leveraging?
I tell you that's the absolute largest you should get. Hey, I helped an entrepreneur who had $1 million in earnings this year sell for an 8 times multiple. He had 1.1 million. He got an $8.8 million payday. And for him, that was victory. And so you don't have to do this on a large scale. We can do this on a small scale. I wrote an article for Forbes that your listeners can research recently. And I called it the rule of 130. When's the right time to sell a business? And I tell people to take their age as a 2-digit number and the percent of their net worth that's tied up in this illiquid thing known as their company. And oftentimes it's, hey, I'm 40 and I got 80-90% of my net worth tied up in my company. That's okay. You've got enough time to recover. But the world's a volatile place right now. We don't have to look very far to see the volatility and how the economic cycles are going up and down faster. And there's all this turmoil and wars and political unrest, all around the country or all around the world. And so I look at that and I think, boy, if I'm 50, 60 years old and 90% of my net worth is tied up in my business, if something bad were to happen, think back to the pandemic, and here, at least in this country, the government shut down the entire country and then decided based on what industry you were essential or non-essential, you're allowed to remain open, you're not, you fail, you succeed. There's all these outside pressures that can impact our business. And if we are holding too much of our net worth or our families, our future generations' net worth in this company and something bad happens to it, we can get cremated with not enough time left in our working careers to recover. So we need asset diversification. Private equity is the methodology that we do that. We don't have to be huge to sell. Again, I helped an entrepreneur with $1 million in 4 million revenue, 1 million earnings, sell for 8 times, and for him, that's like winning the lottery, the sweepstakes. He's a happy camper. So why would we use private equity? Well, it's to find liquidity for ourselves. It's to also get the capital we need to accelerate growth. So let's say, and this is what I really have been spending the last 2 years doing, is teaching entrepreneurs how to do on a small scale what I was doing on this grand scale. I'm the conductor of this large orchestra with unlimited capital, buying 23 companies, 34 companies, put them together, sell it upstream, make billions. I started teaching entrepreneurs and small businesses, hey, let's buy other small companies, combine them with ourselves. Let's climb that PE pyramid. Let's get bigger. Let's do the same arbitrage leveraging on a smaller scale. And so I need capital to do that. And oftentimes I can find that capital by partnering with a private equity firm. I'm responsible for strategy and tactical execution. They help me with strategy. But what they bring to the table is the checkbook and the debt relationships that I can leverage. So classic example, my last company, I bought 23 companies. I paid 5 times earnings on average for each one. And I used 100% debt. And then I turned around and sold the business for 14 times. And if you take the arbitrage, so for every $1 of earnings I bought, I paid $5, and then I sold it for $14. I used the bank's money or the private equity firm's money. And then I made, call it 14 minus 5, $9 of profit by using somebody else's money to roll up a bunch of companies in my industry that were small and less valuable because there's so many of them, there's not enough buyers. And as a result, we make a lot of money. So I'm teaching entrepreneurs to do that. I'm working with one entrepreneur right now who, when I started with him, he had less than $2 million in earnings. I helped him hire a VP of business development. I helped him get in place a $40 million credit line, private capital. And we've now done a buy and build. He's now going to end the year at over $10 million of EBITDA. This happened in about a 14-month period. We're now hiring a banker. He's looking at a $160 million exit. That is a massive amount of wealth creation in a very short period of time from someone who started with what was relatively a small business, less than 2 million in earnings. Now we're going to sell for 160. That's the kind of math that gets me excited for your listeners to remember. And so all I'm doing is emulating the activity that I was doing on a broader scale with large institutional investors. And I'm teaching small people how to do that. That's what my books are about. But that's why we would like to entertain potentially getting involved with private equity. They're not the enemy. If and once we learn how it works, what we really learn is how to manipulate what its needs are to get what we want, which is wealth creation. They have to sell this company they buy in 5 years. So I know I got an exit coming in 5 years. I know that if I can grow it 30%, thank you, Jack Welch, that my business is going to quadruple in size during that 5-year hold period. And that's going to get me a 3x to a 5x multiple of invested capital on the exit. And so what do they need? They need return for their shareholders. What do they want? They want at least a 3x multiple of invested capital, and they want it in 5 years. Well, if I can give it to them in 3 years, because I'm growing at a really high rate, because I'm buying a bunch of stuff, putting it together, creating arbitrage, I can kick them to the curb quicker and boot them out at a good return, good payday for me, and then bring in the next set of shareholders, do it again. My personal record is selling the same company 5 times. So we should not think about exits as a one and done event, entrepreneurs. It is a rest stop on the wealth creation highway. And if we only do it once, we're missing an opportunity to go on a journey and every 3 to 5 years get continuous paydays using somebody else's money to build this thing that we know best, better than anyone else, which is the company that we started and we built.
Oh, wow. There's so much in that. So, and I want to touch on a lot of the terms again in there, essentially leveraging private equity. So investors' money to support us with a liquidity event, which helps diversify our asset portfolio by not only monetizing and liquidating the investment that we've made over the last 20 years, let's say, in building this business, but also using that capital, using that money to enable us to buy other companies and ultimately build out, this kind of group portfolio, which allows us to ultimately get and reap a greater multiple in the context of an exit.
So let me give you just a quick map, 30 seconds. So if I sell my company, I tell entrepreneurs, look, hey, take 70 cents for every dollar, home, 70%, and diversify your asset base, pay your taxes, diversify. Roll 30% forward. On a 4x multiple of invested capital, which is my personal goal, my career batting average is a 5 times multiple of invested capital, which means for every dollar someone invests, they get 5 back. But I model at 4. So if I roll 30 cents forward or 30% forward, and I then build the company with somebody else's money bigger, and I accelerate that pace of growth, when they sell it, if they get a 4x multiple of invested capital, my 30 cents I rolled over, or my 30%, now becomes $1.20. It becomes 120% return on a 30%, rollover investment. I get 120% back. My second check is bigger than my first. My third check will be bigger than my second. My fourth check is bigger than the third. That is how wealth creation truly, and I call that creating generational wealth, is by not just selling a business, a great business once, but actually using private equity as a tool, staying in the game, being a rollover investor. Yes, I'm a minority. Thank you, Jeff Bezos, for showing me I don't have to be a majority to actually make myself the world's wealthiest guy, and so that's the roadmap that I can follow. And I every time I talk to an entrepreneur and I show them a spreadsheet, with 2 rows across, and I tell them, okay, how big are you today? What's your revenue? What's your earnings? What's your growth rate? Let's just plot forward how big you'll be in 10 years. What's it worth when you sell it? Now let's sell it to private equity, take a payday, do the asset diversification, roll over, the 30%, and then get a payday every 3 to 5 years over that same 10-year period. I may get 2 exits, I may get 3, but what's my return on one path? What's my return on the other? How much wealth diversification did I create? What was the growth of those assets once I took them out? Every time I build that formula, every time I do it, 100% of the time, selling to private equity and bringing in a partner and accelerating growth, I earn more money and I have more asset protection and asset diversification by bringing in that partner than I do by staying alone.
So what do you see are the limiting beliefs preventing entrepreneurs from actually embarking on private equity? Because I know on this side of the world, we have this paradigm which centers around owning something 100%.
I call it the arrogance of success, and it's the unintentional arrogance of success. Again, another Forbes article that I wrote, that deals with that. And so, hey, look, to be successful and build a business, the odds are stacked against us. We've talked about the numbers. It's very difficult to do. And so when we do it, actually are one of those few people that build that $1 million or $10 million business, we're special. We're special. But with that special comes arrogance. And we decide, I'm God's gift to business. And because I was an expert in building one, I'm an expert in everything. And I don't need any help. And no way am I ever going to be a minority shareholder, and I'm going to answer to somebody else because I'm God's gift to this business. And so there's an arrogance of success that I think is unintentional. It comes from finding some level of success, and it becomes a limiting factor to us really expanding. And I'll also mention that that's in how we think about capital. But there's also another operational component that I want to mention that we do have 100% control of. When we're starting out and building a business, we have to be an anal retentive strategic control freak, because in order to be successful, we have to get our unit level economics right. We've got to get everything dialed in. Process has to be repeatable. And, we got to control everything to find that initial success. But most entrepreneurs run out of bandwidth at about 20 to 30 million in revenue, and they stop growing because they no longer can control everything. They run out of bandwidth. And so I tell people that there's a gear shift in our entrepreneurial truck here, and we got to learn how to shift gears and go from being an anal retentive control freak, call it the first chair player in every section of the orchestra. We got to learn how to become a conductor. We've got to learn how to manage process and hire good people, but empower them and let them go. Entrepreneurs who can find that gear, who can really let go, can then go from 20, 30 million in revenue to 100 million or beyond. And it all has to do with, to be successful to start, control freak. Get to a certain size, success is built in. I got to let go. And I got to be a conductor rather than the first chair player. And I have to empower people, manage process, use KPIs, and be very strategic about the next wave of growth. And so I think that's where entrepreneurs also make mistakes. So we get arrogant thinking that if we don't have 100% control, the business will fail. I don't want to invest behind somebody else. I need control. You don't need control. If we can learn how to give up that control and partner and use the capital for what it is, which is capital and debt relationships, we can actually accelerate our growth and make more money as a minority shareholder than we can make as it's kind of like, would you rather own 100% of a grape, or 10% of a truck filled with grapes?
And I've spoken to so many entrepreneurs, and at a cognitive conscious level, and rational level, everybody gets that. But is there something that, in terms of the work that you do, that you have to decouple the entrepreneur's identity as the founder and owner of this business with becoming potentially a CEO who is now a minority shareholder of this business?
So there's a fear factor of failure too. So another article I wrote, 73% of all entrepreneurs who sell a company to private equity do not survive the first 5-year hold period. And so I hear from my buddies at the pub, all the horror stories. It's like, I sold to private equity and within 18 months I was let go, and it's like I lost control, and it's like, it was the worst experience of my life, but I am a multimillionaire, so thank you very much. Give me another pint. And I'll tell you that most entrepreneurs, because they didn't have an understanding of private equity, potentially didn't pick the right partner to begin with, to have this symbiotic relationship. There's thousands of firms out there. Just because your phone rings, entrepreneurs, doesn't mean that that's your buyer on the other end. Matter of fact, chances are astronomically, it's the wrong buyer who's picking up a phone and calling you, and so we need to understand what private equity is, how it works. And then we need to understand, what we're looking for in terms of a partnership. And, boy, I bought 58 companies as a strategic private equity backed strategic company doing buy and builds. All 58 times, very few people actually, when the tables turn and you say, do you have any questions for me? Crickets. They don't know what to ask. They don't know how to pick. They don't know how to decide who's a good partner from a bad partner. And so there's this fear of private equity. And then I hear horror stories. The news only tells us bad news. They don't ever tell us about the wins. There's 6,000 firms out there. Some of them are good, some are great, some suck. And in terms of how they invest, there are some, we don't hear about good stories. We only hear about bad stories. And so there are some distressed asset, private equity firms out there that look for companies that are about to die, and they buy them and then they break up the pieces and sell them off. And we hear about all that stuff. Destroyer of jobs, destroyer of wealth, and bad. And then I hear from my friend at the pub who picked the wrong partner and had a bad outcome. Maybe they got a wheelbarrow full of gold and they checked out. I don't want to work hard anymore. I just got a wheelbarrow full of gold. Well, your new owner wants you to work harder than you did because they want to go to 4 times the size in the next 5 years, and you got to be engaged. And so I think there can be a culture shock. There's a fear of private equity because there's always the fear of the unknown. But if we understand and command the facts and we believe in ourselves as a CEO, no reason why I wouldn't want to continue to invest in my own company. And if I find the right partner, it can lead to wealth creation. And I'll tell you that I care about people. I care about culture a great deal. And so I'm known as being a CEO who builds very strong cultures. And so I learned long ago, decades ago, that wealth creation and returns and culture were not mutually exclusive. You could do both. You could build a great company that takes really good care of people, grow it really fast, make a ton of money, and have fun, doing it. And when I hear all the bad stuff about private equity, that's what actually caused me to write the first book. I'm like, this is not the private equity experience that I know. I build strong growth companies with good financial sponsors who care about employees. I've talked about this before, but during COVID, I was owned, the company I was running was owned by Ares Management, one of the largest, they're the world's largest non-bank lender. And they also have this huge private equity arm. They were my owner, and I'm a minority shareholder. And when COVID hit, they helped me create a foundation, and they seeded the foundation with money from their firm and their profits so that I could create a foundation whose goal and objective was I had 3,000 employees. If an employee's family was impacted, somebody died, somebody got sick, they lost income, as a result of COVID, we had a foundation to help them. And it was funded by my private equity sponsor. Classic example of somebody who actually cares about people. We don't hear that story. We only hear, about the bad stories.
Well, a couple of things I want to come to, Adam. First of all, how we discern what a good partner looks like. Whenever for a lot of our listeners, they're potentially curious to explore the potential of private equity, listening to your appeal for people to consider this. How should they evaluate initially and discern what a good partner will look like if they've never actually danced before? And also aligned to that, what are some of the red flags?
Yeah. So good questions. I think to start with, we need to really think about, before we talk to anybody, what do we want for our future? If I'm 70 years old and I really want to retire, selling to a private equity firm that's going to make me a platform, they're going to want me to be a rollover investor. They're going to want me to work harder for the next 5 years than I did for the last 20. Probably not a good fit. So before I sell, I probably need to make sure I've got a number 2 hired who can go forward with the business. And I'll tell the private equity guys, look, I'm 70. I want to retire. That's my goal. But this person is who's actually running the business. I've been disconnected for a while. I'm happy to be a rollover investor. I'm happy to sit on your board. But, my day-to-day, it's like, we need to understand what we are trying to get out of this, and then by understanding our own personal goals and objectives and what we're trying to accomplish, we can then align ourselves with what I call the universe of buyers. And so, a private equity, if let's say I want a rollover investment, but I don't want to report to the private equity firm. I want my life to stay easy. Well, maybe I sell to a private equity backed strategic. And, good example, my last company, I bought 23 companies, 21 entrepreneurs were still there today. Where did the other 2 go? They were 70 something and retired, but the 21 are still there. But I'm the one who had to deal with the PE guys, and I'm the one who had to deal with the pressure as the corporate CEO. They're still there running their businesses, doing what they've always done. But because they sold to a PE-backed strategic that kept the lights on, they got to stay. They got to be a rollover investor. They get multiple bites of the apple, but they don't have any of the pressure of dealing with, call it the institutional shareholder who's got a lot of demands, and a lot of need for data and knowledge and information, asks a lot of questions. And so, I can completely engineer, based upon what I want my future to look like, I can navigate a bunch of decisions before I talk to anyone. Now I can build a profile of who's the right buyer, what is their, how are my goals and objectives going to be served by a particular style of buyer. Now I can have meaningful conversations with just that universe. Once I get inside that universe, hey, personality plays into this a lot. What's their governance model look like? I talk about hands-on versus hands-off. But private equity is business as a professional sport. It's the epitome of business because it's high action, high activity to generate lots of returns in a relatively short period of time. You got to be on your A game. And so the more I understand private equity, I can now think about, okay, governance. Hey, I'm a person that doesn't like to be told what to do. And I'm not going to do really well with a bunch of young analysts getting in my face every week and wanting to know about spreadsheets and numbers, and so I want a firm that's hands off, not hands on. I want someone who's going to deal with me strategically, but leave me to run the day-to-day operations without a lot of intrusion. And so I'm looking for, some firms are very hands-on, some are very hands-off. I've run companies with people who wanted to have, calls with me multiple times a week, drove me insane, but we made a lot of money. And then I've worked for other private equity firms where it's like, I'm looking over my shoulder like, hello, is anybody home? Do you want to have a conversation? So in the world of private equity, there are firms that are hands-on, will give you a lot of help managing. There are those that are more hands-off. And as long as you're doing your thing and hitting numbers, it's like you're not going to deal with them too much. So we learn a lot about the universe. Then we look at the people. This is an arranged marriage. It's like, do I like this person? Because I'm going to spend the next 5 years working with this person. They're going to be my work wife, if you will. And it's like my work spouse, and do I like them? Are they, arrogant, egotistical? Are they hard to deal with? And somewhere in negotiation, as we're talking to people, if we've hired an investment bank, everybody's on their best decision, they're on their best behavior. If we want to date somebody, we treat them really nice. And once we get them where we want them, then we revert to who we really are, right? And so we come out from behind the mask. And I tell you that entrepreneurs, if you're watching closely, when you're dealing with people, while they'll have their best face on while they're dating you and wanting you to say yes to their proposal to buy your company, somewhere in negotiation, you're going to see that real person peek out from behind the mask. There will be some contentious moment. How do they react? How do they deal? That stress, you're now seeing the real person who's hiding behind the mask. And so I'm looking for telltales. Do I like these people? What's their governance model look like? Hey, I want to talk to CEOs, not just of your current portfolio companies. I want to talk to 3 CEOs you fired. I want to see what they have to say. I want to understand if, sure, we all understand something went bad, but how were they treated? How did you treat them? From a contractual perspective, when there was a divorce, what was the divorce settlement like? And so it's hands-on, hands-off. Are they giving me the right path that fits my needs? How are the people and the personalities? Let me talk to some people that had good relationships with them. Let me talk to some people that had bad relationships that ended badly. And let's find out, did they treat them fair? Do they treat, hey, I've been fired. CEOs get fired. It happens. It's like we have differences in opinions on how to grow something. I ran a company for 3 different firms, and then I got whacked, and I had made other people billions. And it's like, hey, when you get whacked, you get whacked. But how did they treat you? Did they treat me fair? Were they good people, good stewards? And I have this unique thing. I've fired a lot of people in my career as a CEO. I've had thousands of employees, over the years in multiple companies. But yet everybody I fired still follows me on LinkedIn. They still like stuff I post. They think of me as a friend. It's like how we treat people matters in life. And so we can learn a lot from CEOs who were fired, probably learn more about that firm than we're going to learn from people who are currently, call it on the payroll, owned by them. Those are the good references. I want to talk to the people who got whacked. That's who I want to talk to. And so, we have to be very judicious in thinking through what's our strategy. Do I like these people? Do I like their strategy? What's their vision for my growth? What's their access to capital? And, what's their governance model going to be like? And let me talk to some people who've been on that journey with them, and let's see what all I learned. You do all of that, I promise you're going to do a much better job picking the right partner.
Brilliant advice. Brilliant advice. I want to come to your most recent book. Congratulations, by the way, and I wish you every success with Empire Builder, The Road to $1 billion. You mention in this book that entrepreneurs universally fail because they don't get unit level economics correct. What do you mean by that, Adam?
So, in life, I was looking at these statistics and just saying, hey, I'm a guy who's built businesses and sold them for billions. Why can't people get to $1 million? Like where are they going south? And I did a lot of digging and did a lot of research. And I thought about the 58 entrepreneurs and their businesses that I bought, what made them successful versus others. And really, I discovered that it starts with unit level economics. And so what is unit level economics? Well, if I'm a manufacturing company, it's my product that I'm producing. My unit level economics, the smallest unit of which I use to generate my revenue. It's like, am I profitable at the unit level? So in a manufacturing company, it's my product. In a real estate investment company, if it's single family homes, it's one house. If I'm a multifamily housing, I'm buying apartment buildings, it's one door. If I'm a service business, it's one truck. I've got an HVAC, company, it's one service technician in one truck. Can I generate enough revenue to cover the overhead costs of servicing that revenue, and then leaving enough gross profit to cover my SG&A or my back office expenses to yield the minimum amount of net profit? And so the way I look at this, I have this thing I call the 30-20-10 rule. In general, I need my gross profit to be at least 30% in any business. I need my SG&A or back office expense to be no more than 20%. I'd prefer lower. And I need to generate no less than a dime on a dollar. And if I can't make one truck work in a service company or one house work as a rental property, I'm never going to build $1 billion empire. And so I tell people, don't worry about scaling until you have the unit level economics yielding a profitable result. Because, how many entrepreneurs have told me over the years, I'll figure out how to make money when I get bigger? No, wrong answer. The one thing in life rich people cannot buy is time. We cannot buy time. Time is valuable. If we're going to fail, we don't want to spend 20 years struggling to get to $1 million only to decide I earned a living, but I never really got success. We want to make sure that success, we stack the deck. To do that, I build economic formulas. So I'm going to use this, hypothetical company. Let's say I've got a landscape maintenance company, somebody who comes and mows the grass in my garden, trims my bushes, and I sign a contract with them, and they come every month. They come every week, and every month. How much revenue can one crew, which is 2 people, 1 truck, a weed whacker, a mower, a blower? This is not the cost to buy the truck. This is the cost of the payment. So it's not the down payment. These are the operating costs. How much revenue can they generate? Well, these people can generate, they can do 15 lawns a day, $50 a cut. And it's, over the course of time, they can generate X amount of revenue. It's $198,000. That's the revenue this crew generates. Great. What's my cost to employ these 2 people, pay their wages, pay their insurance and benefits, whatever the costs are, to create the operating cost of the truck, the insurance, the gasoline, the depreciation, or I have to worry about reserving something for maintenance costs as my trucks get older and they start to break down. It's like, what are my operating costs, for all of these? How much is left? And if I've got at least 30%, what I've got now is scalability. And so I can now say, to hit $1 million, I have to take $1 million, divide it by the revenue per unit level per crew. I need 6 crews. You give me 6 crews, I'm going to have $1.1 million in revenue, and I'm going to have $150,000 in profit. Now, if I want to get to 10 million, I can take 10 million divided by revenue per crew. Now I know I need 52 trucks, 52 crews, and I need so many customers. And so I can build a simple economic formula, and I've built it around the smallest unit level, and at the smallest unit level, I'm least profitable, because as I get bigger, I create operating leverage. So instead of buying 1 truck, I'm buying 50 trucks. Well, I get a better price when I buy 50 trucks than 1. My costs for certain things start to go down as a percent of revenue. And so now my profitability is increasing at a faster rate than my revenue is increasing. And I can really create what I'll call the economic formula to beat the odds, to be one of those 6% in the UK or one of those 7% in the US that actually gets to $1 million and then to a 10 million. And then I also build a capital, expenditure plan around, to get to $1 million, I need 6 trucks. Okay, let's assume they cost $50,000 each. I need $300,000. Well, no, I don't, because I only need to put down 20%. And the rest of it, is going to be financed in my monthly operating cost. The payment's going to be a part of I have my revenue minus my operating cost. I'll put the payment in the operating cost, but I need the down payment. That's my capital expenditure. And on most service businesses, it's about a 1-to-1 ratio. On a 10 million business, I'm going to generate 1.5 million in free cash flow, which is about 1.5 million in net profit. And it's going to cost me about 1.5 million to buy all the stuff to build that $10 million company. It's about a 1-year payback. That's why I love service businesses. They're very efficient with capital. So I build an economic formula. I do all this while I'm small, before I've got a lot of risk, before I've got a lot of time sunk into any business. And I'll tell you that if you already have a business, you can still do this. Stop growth, peel back the layers of the onion. What are your unit level economics? What is your unit level? Is it a product? Is it a truck? Is it a rental property? What is your unit level? Are you profitable? Are you beating the 30-20-10 rule? If you're not, this also helps me. Keep in mind, I help private equity firms evaluate investments. First thing I do when I look at someone's financials is I apply the 30-20-10 rule. If I have a problem, if I'm not generating 30% gross profit, my levers to attack as a business owner, I either need to raise my price or I need to lower my operating cost, my direct operating cost. And I'm going to focus there if I don't have 30% gross profit. And if I've got 30% gross profit, do I have less than 20% SG&A? If not, my customer acquisition cost, my cost of administration in the back office is too high. I'm going to attack that problem, because what I cannot compromise on is I must earn at least a dime on a dollar to be what I'll call a viable business and survive economic, up and downs. And really, I want to get to 15 to 20 cents if I can on a dollar, of profit, 15 to 20%. But I'm going to start with 30-20-10. Does my unit level function? I recently sat down with a multi-billionaire who wanted me to come run a company, and it's struggling, and it's a big company. And everybody in this country would know the name of it. And multiple CEOs have failed. And we were talking about, how do you fix world hunger? I'm like, I don't have to fix world hunger. I just need to fix 1 truck, 1 service call, 1 service event. If I can make that profitable, I can replicate that across thousands of trucks, and I can turn this company back around. I don't need to fix world hunger. Let's fix 1 truck, 1 service call. Get this right. I can replicate that across the fleet. Maybe there's some technology, maybe there's different cost structure that's needed, whatever it is. It's like business success large starts with business success small. What are your unit level economics? Peel back the onion, follow the 30-20-10 rule. You can do these things. You can build a mathematical formula that takes you to a place where 94% of entrepreneurs in the UK don't get, or 93% in the US don't get. And then where only a minuscule percent get to 10 million, I'll make that so easy for you and so efficient with time that if you can't get it right, walk away. Don't waste time. Sell the little business that you built, start a new one, because if it's not passing the 30-20-10 rule, if your unit level economics aren't working, scale is not going to help you. It's going to aggravate your problems.
Oh, I love that. We have a saying here, simple scales, complex fails. And what you're saying there is so profoundly simple and resonates so strongly. My background's in finance, qualified as a chartered accountant, then went straight into industry. And I just love the simplicity of your message. And I'm
a simple guy. When I think about my roots, I started at the bottom and I worked my way up. I was a private in the United States Army. I looked up and saw bubble gum on the bottom of somebody else's shoe. When I started my career after the service, I was a guy in a truck doing service at hospitals. It's like, I have held every job a person can hold on an org chart, but I've never become sophisticated. I've always been a simple person. I try to take complex problems, break them down to their simple components. And then that's what I write about. And that's what I teach, is how to demystify the complexity. I've spent a lot of time with a lot of billionaires now. I'm a wealthy guy. And I can tell you, when I look at them, I walk in their homes, I'm like, and I get to know them as people, and I'm like, they're not any different than you or I. There's nothing special about them. They were just successful. Why did they find success? Sometimes it was luck. Sometimes it was sheer tenacity or just a grit and a determined effort. It's not like there's a special gene, and these people are anybody can become wealthy. Anybody can become successful. We just need to learn from others, be open to learning from others, and then implementing best practices. We learn as we grow. I wish somebody would have given me my 3 books when I was starting my career, 40 years ago now.
Here. Well, speaking of your 3 books, before we move into the close, is there anything that you feel we haven't touched upon today that is fundamentally important in the context of inspiring, connecting, and enabling the ambitious leaders of SMEs who are listening to this podcast today?
Yeah, I'll give you one thing real quick, and that is, I think at some level, when people start thinking about success and planning for success, I have the greatest idea on the planet, Adam. Give me your money, and I'll be successful. I think about greed, and I think about, if people just chilled out and recognize, look, you need capital. You think there's no capital out there, it's hard to get. The world's full of capital. Treat capital well. If the prevailing interest rate's 10%, or 12%, well, give them 12%, then give them 10% of the profit on the company you're going to build with their money. It's like, if you are generous to capital, you'll find capital. Recently, I was with 3 partners. 4 of us together are creating a business that I hope to one day sell for $234 million. It's a pretty exact number, right? So I've got the exit worked out from the back, back to the beginning. And we're talking about splitting up the pie. And it's like, what? It's like, I'm going to watch how this conversation goes. And it's like, look, if I've got a couple $100 million exit coming in 3 years, do I care whether I own 30%, 25%, or 35%? It doesn't matter. What's important is, let's get beyond this problem. Let's just get to the business at hand, which is using all of our skills to build this business. And so, it's like, don't argue over pennies. Don't argue over who controls what, or it's like, if you can put away greed and just recognize that success is hard enough on its own, if we can align ourselves with people, if we can be good to others and treat others fairly, including our employees, success that we find, will be fruitful. And so, I gave one of those partners, it's like, so it was like, you get 30%, you get 30%, you get 10. It's like, well, one person was going to pay out of their percentage, the other person's percentage. I'm like, why are you doing that? They're adding value to all of us. I'll give up a part of my ownership. Let's make sure we take care of this person, because they're critical to our success. So it's like, be fair. you can be fair, and if you can treat others well and stop being so greedy when you have nothing, you'll find that when you're not greedy and you start getting big paydays, hey, making money's easy, making money's fun, and treat people well. That's my advice.
Wise advice beyond the context of the conversation that we're having today. This is a lovely segue into our close. You have had such an incredible life and career to date, just an abundance of experiences that only a portion of us can ever dream about. Adam, what 3 timeless takeaways can you share with our listeners today?
So I think I shared one, which is be good to people. But if I think about it just from business terms, if we're building a business, I'll say focus on needs, not wants. Needs, not wants. Economy moves in cycles. If we're focused on supplying wants, I want a new truck, I want a new outfit, I want, I want things. If the economy goes south, if my income is under pressure, I can delay spending on wants forever, indefinitely. The economy moves in cycle. Avoid cyclicality. Focus on needs. I once ran this large laundry company, and it's a commercial laundry company. What I learned was unemployed people don't do as much laundry as employed people, but all people need to do laundry, right? At some level. If my focus in business was on supplying wants, then I'm going to be subject to all kinds of economic volatility. We want to avoid volatility. Second thing, recurrent revenue versus non-project based revenues. So, if I can build a company focused on needs, that I can then create a contracted revenue stream around, so recurring revenue, I'm going to be rewarded by whoever eventually buys my company for that stability in income. Needs, they got to have it. Contracted, the first of every month, I'm going to hit their credit card or I'm going to bill them and they're going to pay it. And so the revenue streams are solid. Think about a project-based business. So if I'm in a construction world, not saying don't be in construction, but if I'm running a construction-based business that's all project-oriented, economy goes south, people slow down projects, my revenue comes under pressure. Versus if I have some kind of recurrent revenue stream. And so I'm always telling people, if you're focused on wants, not needs, you got problems coming. Start dealing with it now. Think about strategic pivots. How can I add ancillary revenue streams that are more resilient, that get more focused on needs, not wants? How can I create a contracted revenue stream versus one that's project-based? Because the hardest thing for all of us is to go find a customer. So once I find a customer, let's find more things to sell them. And let's get a contract in place so they'll keep on paying me. And let's make sure it's needs, not wants, so that they can't get rid of me, even in a bad economy. Focus on these things. So these are the basics. And then I'll tell you, have a destination in mind. Where am I growing to? Let's get to a specific size where I'm going to evaluate whether it's time to monetize my asset by bringing in a partner, or I'm going to keep going. There's natural exit points in life. 4 million in earnings is a great exit point. 10 million in earnings is another great exit point where different size PE firms will come in and buy, and they'll pay up. There'll be multiple expansion that goes on, at these levels. So how big a business are we going to build? Have a destination in mind. Don't just start a business and not know what the heck we're doing. I'm building a business. I want to get to the first million, first 10 million. At the first 10 million, I got 1.5 million in earnings, which means I need to get to 30 million, 4.5. I'm going to sell 8 times, 32 million. I want that wealth creation in 5 years. So have that destination in mind. Needs, not wants, recurrent revenue, destination in mind, and then an economic formula for revenue and for capital expenditures. And then finally, who is going to hold me accountable when I'm not hitting my numbers? I find for entrepreneurs, that's where most also get into trouble. I'm a CEO. I have a board. I'm a minority shareholder. People can fire me if I don't hit my numbers. Who fires an entrepreneur if they don't hit their numbers? Nobody. How are you going to hold yourself accountable? I was working with an entrepreneur recently in a roofing company, and I quickly figured out, look, the reason that you have the performance you do is you lose money in the first quarter. We have to make it to where it is, the world will end if we lose money in the first quarter of 2024. If you knew you would die if you lost money in Q1, how would you run your business differently in Q4 and in Q1 next year to make sure that you don't die? And for entrepreneurs, no one holds us accountable except ourselves. And so I think we lack a sense of urgency and a sense of holding ourselves to our own numbers. And that's one of the things we fear. So those would be somewhere in there. Those are my 3 nuggets: needs, not wants, unit level economics, formula for success, and then accountability, destination in mind. That's probably 4 or 5, but I think that's the lesson.
You are just packing this podcast with value today, Adam. Look, I want to thank you sincerely for your time, energy, and wisdom. What's next for you? Because it just sounds like you have a ball of energy waiting to get out there.
I'm having a lot of fun. I really am. I'm working harder than I ever did. World tour, I think, is coming up in 2024. I want to say thank you to the people in the UK, the people in Europe, people in Australia, who all made my book #1 bestseller again, 3rd time in a row. At one time in Australia, there were my books. I only have 3 books. I held down the top 8 spots for books in Australia at the same time. So you had like paperback, hardcover, Audible, all 3 books, were the top 8 books. And so I want to get out and do a global tour. I've been doing seminars and the globe has been coming to me. I want to get out and see the world and tell people thank you and start building call it a bigger sphere of influence that goes beyond the US and Canada. I have a following now in Europe and Australia, but in Singapore and places like that. But I want to get out there and just, I'm having fun helping other people succeed. You own tactical execution, listeners. I'll help you with strategy.
Brilliant. Well, I hope and I welcome you to this part of the world as part of that world tour. Adam, if people want to get in touch, which undoubtedly they will, where best to reach you?
LinkedIn is easy. I respond to everybody. So you can find me on LinkedIn, Adam Coffey, Coffey. There's adamcoffey.com. There's adamecoffey.com. It just depends on what you're engaging with. Seminars, my peer groups, is through adamcoffey.com. But LinkedIn, I'm on LinkedIn daily. I respond to people as much as possible. And so thank you to everybody out there for tuning in. I always enjoy these. It's fun, going down different rabbit holes each time.
I love it. And I said at the outset, I wanted to get an insight into some of the practices which undergird your incredible energy. Can you give us a kind of a 60-second day in the life of Adam in terms of the things that are non-negotiable for you?
Yeah, I get up early. I get up at 4 o'clock in the morning every day. I don't want to call it old Army habits die hard because I've been nocturnal. But what's important, I think, is that we as entrepreneurs find time in our day to be strategic. For me, that's the hours between 4 and 6:30. 6:30, get ready, say goodbye to the kids, go to school. And then my day starts on calendar at 7 a.m. And it goes through to about 5 p.m. Yes, I'll do stuff off hours, but I try to make sure I schedule time. Great study done by Harvard, successful people, time management. Go read that study. You'll find a lot. So non-negotiable, I need to have private time in my day to be reflective, and to be strategic and think about and to do follow-up. And so I create those gaps and those windows in my day schedule. Going back to back, meeting. We're so busy being busy, we never accomplish anything. Need to learn how to be strategic, need to learn how to work less, but be more impactful with your time. To me, that's non-negotiable. Family's non-negotiable. We all learn the hard way, so, I'll tell you that if I had any failure in my life, it was the failure of my first marriage. It was a divorce. I'm chasing money, chasing title, and forgetting what's most important in life is family, and so being there for my kids, non-negotiable, making sure that I'm present My wife could care less how much money, I make, if we're flying on a private jet or not. She wants her husband home, at daughter's recital, and there are certain things that are just non-negotiable. And then finally, I would say culture is non-negotiable for me. If I'm involved in running a company, building a company, I'm going to take care of people. If I take care of people, I get a strong culture. I get an engaged workforce. They take care of customers. Customers give us more stuff. Revenue rains from the sky. And non-negotiable. You're going to hire me to be a CEO, then you just need to know that I'm going to invest in people. I'm going to care about people. And if I can't find a way to make people successful, then then I'm never going to get to your financial return unless I start there. And so if you can't sign up for that, don't hire me. It's peace out. And so those are kind of some of the non-negotiables with me. Family is important. And taking care of people that I work with is important, and having private time to be strategic is important. It's not how many hours we work, it's how much we accomplish in the select hours that we choose to work.
There's a whole podcast in that last 5 minutes alone. It's just brilliant. Adam, look, once again, I want to thank you for your wonderful wisdom, the value that you've given me and our listeners today. I wish you every success with everything you're doing, and looking forward to actually connecting with you in person during that World Tour. So take care.
It sounds great. Thank you very much. Happy holidays to everybody out there.